us. Now let's move on, and we have Pramod Gubbi now joining us, co-founder of Marcellus Investment Managers. Pramod, hi, good afternoon. Thanks for joining us. This everyone has been calling this as a liquidity-driven rally. Do you reckon that perhaps we have reached some kind of near-term climax for that rally globally? If you look at what happened with the Fed decision yesterday and the way the markets have responded throughout the globe, not just in India?
Well, it's always difficult to predict short-term price movements, but I think given the sort of strong rally we had, the market was set up for a breather of sorts. But I don't think the Fed's comments yesterday should change any of that. All the Fed has said is acknowledge the weakness in the current economy, and have actually committed to keeping interest rates low for a significantly longer period of time, which means that the cost of capital will remain low, and therefore to generate higher returns, funds will have to flow into riskier assets, which is predominantly including equities, within that emerging market equities, of which India is a part. So I don't think that the liquidity will take an adverse turn on the back of these events. In any liquidity-driven rally, you are bound to see such periods of a breather of sorts, and that's perhaps what we are going through. Of course, there will also be other catalysts. Perhaps, given the sort of number of cases that we are seeing, which is sustaining, increasing regularly, that could be a cause for a negative catalyst in the interim. But the longer run liquidity effect, I don't see changing. Liquidity remains benign and is likely to remain so going forward as well.
Pramod, good afternoon. But that is exactly my next question to you. That other factor that you spoke of, this trade that we saw, the leg up, a large part of it was the unlock global trade, right? The reopening trade, including here in India. Now, if the infections start spiking up again, then can this trade start to unwind? And is that a risk that the market has completely not taken any cognizance of till now?
Well, hard to predict again because we don't know how the cases are going to react. Of course, there will be a surge. The question is, will the surge be to an extent that there will be another phase of lockdown by governments globally, particularly in a country like India, where we have actually unlocked despite the trajectory of the cases being on the positive side. So it all depends on what sort of surge in cases we see. Because remember, the government has decided to unlock because the need of the economy is far more dire at this stage, despite the number of cases increasing. So it might be the case that the surge is there, but it's not alarmist to the extent that we go into another phase of lockdown. So a lot of unknown variables here. I won't want to, second guess, but my sense is if we don't see a significant surge, we may not see another phase of lockdown, in which case the gradual recovery that the economy is seeing will continue to progress, and that should continue to provide some sort of a tailwind to the market.
Okay, by the way, the Nifty is trying to defend 9,900 and the Bank Nifty 20,500. So let's see if that defense is successful or not. Some of these economy-facing stocks have started to do well. Pramod, the market's already looking forward, perhaps. Auto stocks, for example. How would you approach them from a portfolio point of view? Complete avoid or selectively look into some of them?
I think definitely auto has always been a sector which has created a lot of value for shareholders, not just in India, but across the world as well. It is cyclical in nature and by the very nature of its demand. Perhaps we are looking at a very unique aspect of its demand driver today, given that people are still a bit averse to taking public transport. And we've seen this trend play out in other parts of the world where post-lockdown auto sales have gone up. We're seeing similar trends in India, particularly in two-wheelers. To that extent, in this whole drought of economic activity, we're seeing auto sales perk up, and that might drive the next cycle for automobiles. And given that there are some fabulous companies in the sector, we should definitely take a selective bet in some of the names, particularly the two-wheeler names in the country.
Okay. What about the rest of the consumer pack that you participated and observed so closely at Marcellus, Pramod? Now everybody's trying to understand what the trends are going to be like, whether discretionary spends are going to come back or whether it will continue to be staples. And if you think of incrementally adding on positions, will they continue to be in your existing stocks? Will the preference be more for discretionary over staples?
No, I think we have a reasonable exposure to both discretionary and staples. And here again, I wouldn't go top down in terms of demand, particularly in staples or even discretionary where the product or service is a low value item, a low ticket item. I don't think you can keep demand down for far too longer, particularly in a country like ours, which is still bulk of the consumption basket of most people is full of essential items. I don't think demand will go away. So therefore, I would rather not work from the demand perspective. Demand is a given in a country like ours with these sort of demographics. Where we would rather focus on is, given this sort of demand, will the company under question be able to capitalize using its competitive advantage, take a disproportionate share of that demand, and in the process increase its margins and increase its returns on capital. So we have companies like ITC and Nestle among staples, and we have companies like Page and Relaxo in our portfolio, where we think these are still in some ways where demand can be postponed at best and cannot be eliminated. These are not discretionary to the extent of, say, jewelry or automobiles. And therefore, as long as the companies in question are very strong in terms of competitive advantage and more so very strong balance sheets to tide through a relatively lull period of demand, we're quite comfortable having an exposure to both these sectors with the select names that we have.
Okay, Pramod, we'll leave it there today. Thanks a lot for joining us. Completely take your point. Nobody can predict the near-term market moves. But for now, the 3 p.m. move, there's no 3 p.m. move as such now. It looks like the market will defend 9900 or it is in a mood to defend 9900. But today has really changed the texture of the market. And I say that because, what's happened is global markets. If you see today, Asian markets ended with about 2 to 3% cuts. Hang Seng 2.3%, Straits 3.5%. European markets right now are down 3% on an average. DAX, CAC, FTSE all down between 2 to 3%. And if you take a look at what's happening to the Dow futures are down 534 points. So the market's giving a message that perhaps with this Fed's outcome, that one leg of liquidity-driven rally is perhaps out of the way. We'll take a break. We'll come back with the BTST calls, and Ronak Onkar will be joining us from Parag Parikh Financial Advice Services Mutual Fund with his perspective on the market.